I kind of want to start with where Hell just ended, the interest rate picture, because we are seeing the Riksbank raise rates to flat, to nothing. German bond yields are still negative on the 10-year side of things. So is the interest rate dynamic right now one that's kind of conducive to perhaps the bull run continuing?
I think the rate story is actually going to be the biggest story of 2020. If the stock market is right, that growth now inflects higher upon a trade deal and a soft landing by the Fed, well, I can't imagine that long rates in the U.S., in Europe, in Japan, and others are going to stay where they are. And I think this tick up in the 10-year at 195 at the upper end of this trading range is really important to watch, because if we do get a further rise in interest rates, if what the Riksbank did maybe is a precursor to what the ECB plans on doing and getting out of negative interest rates, the rate story is going to be a big deal, because you still have $11 trillion of negative yielding securities. Just imagine what happens to those bonds just by going back to zero. You're going to get a large inflection higher in interest rates, and in a debt-addicted world that is dependent on low interest rates, I think that that's going to be a real test for equity markets.
Two-part question. What's driving predominantly the move in rates higher in the U.S., and then what's driving it for places like in Sweden, elsewhere around the world?
Well, I think it's a combination. Number one, certainly the trade deal that has gotten this recent uptick to move. Obviously, there's this hopes that it brings back manufacturing confidence and growth starts to move higher again from the 3% to 2% to maybe back higher above 2%. The Riksbank, I think, is a big deal. It's basically putting a floor under interest rates. You have the Japanese that want higher long-term interest rates. You have commodity prices now that are at the highest level since May. And you have the possibility that just maybe in 2020, if Europe's growth at least stabilizes, that maybe Lagarde's going to try to get out of negative interest rates.
Is the economic backdrop in places like Sweden, Germany, Japan conducive to being able to have a trajectory of interest rates higher for the medium to longer term?
Well, I'm of the opinion that negative interest rates is actually restrictive monetary policy, because it does damage to your banking system. So while it will be hugely disruptive getting back to just zero, and you could see a sharp rise in interest rates around the world, which would be a growth dampener, I think over time we need to get out of this rat hole of negative interest rates.
So negative interest rates, as we talk about the dynamic here in the United States, we're obviously not negative, but there is this notion that as rates rise, the president of the United States will be less and less happy about them. Can the U.S. economy be okay or move forward with rates gradually rising?
Well, he'll focus on the Fed's influence on the short end. I think longer-term interest rates, if it's a gradual move higher, then we can adjust. But anything that's sharp would be highly disruptive. I mean, look at housing right now, which is trying to get its legs. Well, you can take those legs away if all of a sudden the 10-year goes to 2.25, 2.5, 2.75, which was just where we were not too long ago. So it's really the pace of the rise that is key. But I said this in a note I wrote a couple weeks ago. When you wake up, yeah, you want to look where the S&P futures are going, but you should also look at where the 10-year JGB yield is, look at where the 10-year bund yield is, because that will tell you where the 10-year in the U.S. is, and that direction may tell you where equities go in 2020.